Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields still trading on the high side of the range, but at the inside the range nonetheless. And I think that since the post-FOMC trade, we've seen a modest decline, maybe 2 to 3 basis points in the 10-year yield, getting us to about 305, 306. So we are still looking, for that catalyst event, which will either take us above 310 for some sustained period or back to the mean, which is right around 290, 295. And I think ultimately things are very unclear at this point, whether we look at economics, whether we look at policy, whether we're looking at geopolitical aspects. There are, and you also have to look at the fact that while rates are going higher, equities are also going higher as well. So there's a lot of variables there, and it's still very unclear as to the direction of where rates are going. There is the expectation because of the supply, like we saw today in the 7-year auction, may be received more poorly, and that will drive rates up as well. And so you have that category to consider as well. So right now, the market just kind of spinning its wheels a day after FOMC, a day after the Fed raises rates. And if you look at market volatility, well, we still are in that range. We are still trading within that range, although we expanded it a little bit. We are still there. And volatility gets crushed. We're nearing year-to-date lows in market volatility in the post-FOMC trade. And I think ultimately, the only thing that's going to get market volatility higher is going to be a move in the underlying. And at this point, it seems that move has to become higher yields, not lower yields. Lower yields could come from another number of reasons, whether it's geopolitical risks, whether it is supply and demand, whether it is some credit event. But ultimately, I think a move towards higher yields is really what the market is not expecting, and that would be the main cause for any bid to volatility. And lastly, let's look at the curve. 2s10s, which was north of 25 and felt like it was steepening on its way back to normalization, is nearing 20 again. So since the Fed, it's really everything's just kind of reversed. We've seen the curve reflatten. Obviously, 2-year yields have been rising in lock and step with what happened with the Fed. And 10-year notes are still, just like I said, very unsure of what's going on. So 2s10s is now back nearing 20. Gets back below 20, you got to start talking about the inversion theory that goes back and forth, that with inversion will come recession. And while that isn't the case today, certainly expectations are for those to continue on their path flatter. So a flatter yield curve, 10-year notes which are stubbornly just waiting for something to happen, lower volatility. A lot of this doesn't ring in any kind of sensible trades. However, I think in the long run, we're going to have to look at the economy. We're going to have to look at what's happening coming into year end. And we have this pesky midterm election, which is coming in November. And that could have a say in what happens with the fiscal policy here in the U.S. So right now, 10-year note yields uncertain of where to go next. We need to move higher in yield to get volatility up, but likely we'll see a move back to the mean. This is Todd Colvin coming to you from the floor of the CME Group.